Hey everybody, the long-awaited budget reconciliation bill was unveiled this week and there is a lot to unpack here. I want to talk about it in this week's Office Hours episode. Now you'll remember that the budget reconciliation proposal is essentially tax reform. It's been put forth by the Means and Ways Committee, and it's 800 pages long. It is nowhere near law, but I think it's really important to see what's in it. Now, the first thing to note in the new tax proposal is that the individual tax rates at the top bracket are going up. Currently, it's at 37% for the highest bracket, and that's going to 39.6%. Additionally, if you make over $5 million in a year, you can expect a 3% surtax on your income. The other biggie is capital gains for individuals. Now, capital gains are currently capped at 20%. That number is going up, but it's not as bad as feared. They're proposing 25% for the top capital gains rate, which is a far cry from what Joe Biden originally wanted, which was ordinary income. Now, today's corporate income tax rate is 21% across the board. The new proposal is to have corporate taxes at 18% on the low end, all the way up to 26.5%. Now, a lot of corporations will be happy with this because they've been floating the idea of doing 28 to 35%, which is where it stood back in the Obama era. Now, retirement plans will be impacted, but maybe not as much as we thought they would have. They're ending Roth IRA conversions for people in the top tax bracket, but not until 2031. That's to encourage the current revenue for the IRS from when people convert their pre-tax IRA money to Roth money. Additionally, they're ending the after-tax Roth component of retirement plans at work. Now, anybody with an IRA or retirement account over $10 million has a little bit of planning to do. First of all, they're going to disallow you from making contributions to either a traditional IRA or a Roth, regardless of your income level and regardless of deductibility, if your IRA is over $10 million. Personally, I'm not sure why they're worried about a $6,000 deposit to a $10 million IRA, but that's for the government to figure out. Second, and more importantly, they're going to require required minimum distributions from those accounts if they exceed $10 million. It's going to be a 50% of the excess required annually. And what that means is if you have an $11 million IRA, you're going to need to pull out $500,000 the next year in an effort to keep that account at $10 million or less. The $24 million estate exemption was scheduled to end in 2025. This proposal has it ending after this year. Anybody who passes away after December 31st, 2021 can expect their lifetime estate exemption limit to go from 24 million back down to 12 million, where it was prior to the Trump administration. There were some big omissions from the bill. First of all, billionaires can breathe a sigh of relief. There was no talk of a billionaire wealth tax. This was that discussion of taxing the net worth of someone who had $1 billion versus their annual income. Another pleasant omission was no changes to the deductibility of contributions to retirement accounts. There had been this idea that maybe anything you put into a retirement account, instead of deducting against your top income, you would simply get a 28% tax credit for. Now, that would obviously help people in low tax brackets and hurt people in high tax brackets, but it appears that today that's remaining unchanged. That 20% self-employed business deduction is staying around. Section 199 qualified business income is remaining unchanged if you have $400,000 or less in income for individuals or $500,000 or less for a couple. Now, the state and local tax deduction against federal income is unchanged at $10,000. It's a little bit of a surprise because many people expected you to be able to deduct your full state and local tax against federal income taxes like you could up until 2016, but there was no mention of changing that now. Notably absent as well were changes to unrealized capital gains at death. As it stands and as it is proposed, heirs will continue to keep the cost basis of inherited assets going forward. Now, as I mentioned, this proposal is far from becoming law, and it's 800 pages long, and I'm sure there are plenty of highlighters and red markers going over this thing as we speak. But I think what we can expect is that a lot of the language that was originally thrown out there is going to stick, and a lot of the things that were not even put in the first draft are not going to make the final draft. Finally, this is going to be unrolling over several years. Some of the capital gains provisions might be effective as of September of this year. Others are not going to go into effect until 2022 or even 2031. There's obviously a lot that's going to change between now and then. We'll try and keep you on top of everything. But if you have any questions or thoughts along the way, feel free to reach out. Give us an email or a call, 530-487-1777. We're here to help.